Hi, my name is Mark Morris. I'm a senior sales executive at SmartStream Technologies. I'm really pleased to be talking at the Asian Risk Awards today. I would like to talk to you about managed services and how they can change a customer's complete operating model and strategic outview of their control domains and processing capabilities. Managed services have been in vogue for a number of years. Primarily, financial institutions use them as a lift and shift of their incumbent processes, typically onshore and expensive metropolitan cities, to either their captive organisation in a cheaper zone or to a third-party vendor. This was conducted in kind of a lift and shift capability where no change or innovation was invoked, but it was just done to create that labour arbitrage and make it cheaper, but not necessarily more efficient. Also, it was typically using the financial institution's own technology and not future state technology and cutting edge technology that some of us can now provide. I think also post the financial crisis, the securities processing stack has been left pretty much untouched. A lot of the discretionary budget spend and innovation dollars have gone on mandatory regulatory projects, which have sat mostly in that derivative space, whether it be Dodd-Frank, EMIR or MiFID, and hasn't really focused on the poor old securities world. And they've been chugging along quite well for the last 15 years, but without a lot of tender loving care. I think also over the last 2 years, COVID-19 has really hurt some organisations hard. It's exposed weaknesses in their ability to remote access their own systems and data from outside of their main office space. And also some of the third parties that they use have struggled as well. And it's shown up gaps in location strategy and also in their operator model constructs. One of the case studies I'd like to talk about is a hybrid approach that we struck with a prominent European buyside company. They already had SmartStream Rex on a hosted premised solution in their own shop, in their own data center, and they'd acquired a new asset manager. As part of their due diligence that they conducted, they realized pretty quickly that their own version of SmartStream would not be able to cope with these accumulative new volumes that were coming in from this inbound new business. And they reached out to us to see if we could help them and partner and create a hybrid construct where their old business would stay on their on-premise solution, and we would build them a cloud version in the private cloud that would give them the scale and volume capacity that they required. They also said, we don't have much by way of professional service expertise. Could you provide a project management team to help us deploy these projects? Which we said that we obviously could. It went through very well. They were able to acquire this new company and process these bigger volumes on our cloud-based solution. The wins for them, they had dedicated subject matter experts that were very, very conversant with our technology, both from a technology perspective and also from an operational lights-on perspective. By getting the future state tech from SmartStream, they immediately got all of the AI and machine learning kit that we bring, and that ensemble really helped to drive through efficiencies for them. They also were able to upscale and future-proof any other businesses that they wanted to acquire in the next 3 to 5 years. They also future-proofed any testing, any system upgrades, because we would own that on their behalf. And also they benefited from our best-in-class security. And certainly in this day and age, from a risk perspective, with cyber attacks and everything else that's going on, that deprivation of service is a big worry for financial institutions. Also, as part of our key deliverable to them is a monthly KPI deck where we go through the whole control domain and heat map of their process chain and show them exactly where things are working and where things might need a bit more attention. Over the last 20 years, I've worked in a number of global banks and worked in sort of global post-trade operations. And I've seen teams in my investigations departments around the globe not resolve breaks in a timely fashion. And I've seen stuff where almost there's like a game of tennis between departments where a cash or stock rate gets moved around 2 or 3 days before it gets resolved. We really don't focus on it that way at our shop. We're actually trying to stop the break happening from the get-go. And we will use our AI and machine learning to understand what caused the break, what was that root cause, and then work with the client to see if it was client behavior Was it their desk behavior, operational behavior, or is there something embedded in the reference data that's wrong? There may be some kind of rounding logic between them and their counterpart that creates a cash difference every day that's outside of their tolerance levels. By bringing that piece of kit to them and also enabling them to have access to our innovation labs and experts in Vienna, in Bristol, in England, and in India, it really helped them partner and develop their solution a lot better. I think also there's an understated win and from a risk perspective, it really should be looked at more closely. And this is some of the things I'm working on with our clients at the moment. Because if you can reduce your number of cash breaks, that really impacts your ability to predict your funding forecast. And certainly for the smaller organizations out there that are borrowing money every day, their ability to understand what their intraday liquidity provision needs to be is absolutely vital. And a cleaner cash stock, end of day cash position and start of day cash position will give them that integrity. Also, if you're a regulated entity, certainly in the UK, and I used to be the CF10A at RBS, then understanding what your client money lockup is every day, vital, has to be accurate 100%. From a stop rate perspective, that's equally as important, because if you have a clean stop record and have low stop breaks, then you can then run your corporate action, coupon and dividend management programs a lot cleaner and make a better client experience. And also lower stop breaks means lower failed transactions. In Europe, especially next year with the advent of CSDR, then failed trades on the back of stop breaks will be very evident to the community. And with that reputational risk that comes with having poor settlement rates, good stop record will be very important. There's one other thing we're working on with a client at the moment. It's actually an Asian-based buyside. They've got a very fractured operating model at the moment with about 7 or 8 different offices across the region processing in different ways. And they've asked us to help them build what I would call a hub and spoke model, where they'd have a centralized center of excellence in Singapore. And then through the cloud, we'll help them build out that spoke and satellites across the region, everybody doing it in the same way, all the data being on the same hosted cloud platform, and it will give them a real good insight into how everything should be processed. They'll have common KPIs, common metrics, and they've also got obviously the SmartStream support model. Again, they've future-proofed any upgrades and testing. We provide all of that for them. And I think that's really excited their management, and they're going to reap the rewards from an efficiency perspective. And, you know, what we've seen typically when clients move to a on-demand managed service, they see a 30 to 40% cost save, because purely the efficiency wins that they get from our expertise and our understanding of our product, it's actually sacrosanct. I'd like to thank you all for this time today and wish you all the best for the rest of 2021.